Welcome back to the Did You Know channel. If you've been following me for a while, you already know that my videos are designed for listening. But if you're new here, you don't have to watch the screen. Just listen. Feel free to play this in the background while driving, working out, or doing anything else. Because today we're going to talk about how low the S&P 500 might drop and when it could find its bottom. Of course, predicting the market is never easy, but by looking at historical data and key facts, we can get a clearer picture of what's happening and what potential scenarios might unfold. At the end, I'll share my personal approach, what I'm currently doing in the market, what I'm watching, and what my next steps are. So, if you're interested in where the S&P 500 might be headed next, make sure to stick around until the end. Let's get into it. Now, let's clear up an important concept: the difference between a correction and a bear market. If you trade or invest in stocks, you've probably heard these terms before, but if not, I'll explain them in a simple way. When the market drops by less than 10% from its recent high, it's called a pullback, a normal short-term fluctuation. This can happen when investors take profits or when there's minor panic in the market. However, if the decline reaches between 10% and 20%, we call it a correction. This is a more serious signal, indicating that the market is shaking up and investors are becoming more nervous. And when the market falls by more than 20%, we officially enter a bear market. Peter Lynch put it well. It's a period when investors start losing money very quickly. On the flip side, if the market rebounds from its bottom and rises more than 20%, we call that the beginning of a new bull market. Understanding these terms is crucial because knowing which phase the market is in helps you make better investment decisions. So, where are we right now? When we look back at history, we can see that similar situations have happened before. The market has gone through multiple declines and recoveries, and while each case is slightly different, the patterns tend to repeat. In 2016, the S&P 500 dropped by 14%, which was a standard correction. Then came 2018, when the market fell exactly 20%, nearly entering a bear market. This situation is interesting because back then, the Fed was raising interest rates, whereas today, rates are not increasing, but everyone is speculating on when they might start coming down. The fastest drop in history happened in 2020, during the COVID-19 pandemic. The market crashed 35% in an extremely short time, but it rebounded just as quickly. And then we have the most recent major drop in 2022, when the market fell 27%, taking an entire year to find its bottom. So, where are we today? Right now, we're in a correction. The S&P 500 has fallen 10.5%, but it has also bounced back. The question now is, was this just a short-term fluctuation, or is there a deeper drop ahead? When we look at the current state of the market, we can see that the S&P 500 is testing key levels. One of the most important levels I'm watching is 4,935 points. If we drop below that, it would officially signal entry into a bear market. For now, we're still in a correction. A drop of 12% to 14% would still be within normal limits, but if we break below that key level, it would be a sign that things are getting worse. So, what does this mean for investors? If the market is just going through a temporary phase of uncertainty, we could see a bounce and a continuation of the uptrend. But if another major drop happens, it's important to be prepared. That's why it's crucial to keep an eye on what's happening, not just in the indexes, but also in individual stocks. Strong companies might present interesting buying opportunities during this period. Now that we know where the market stands and where it might be headed, the big question is, how should we approach it? Personally, in situations like this, I use put option selling on stocks that have dropped 40–50%. These are companies that may have lost value in the short term, but their fundamentals remain strong. I also keep a close eye on the Fear Index, VX, which is a great indicator of market volatility. When the VIX is around 20–30 points, it signals high uncertainty in the market. And these are exactly the moments when it pays to be active. My long-term focus is on high-quality companies trading below their fair value. When the market dips, many stocks reach attractive price levels, and gradually buying in at the right moments can lead to great results over time. It's not just about short-term fluctuations. It's about a well-thought-out strategy. That's why I combine long-term investing with short-term swing trades, using options to take advantage of market movements. When we look at how investors are behaving right now, we can see a clear trend. market sentiment is extremely negative. And that's what makes this interesting. If we look at historical data, we'll see that we've been in a similar situation before. For example, in September 2022, retail investors were extremely pessimistic, expecting the market to keep falling. But that was exactly when the market found its bottom and started to recover. Another important factor to consider is market seasonality. If we analyze the average S&P 500 trend over the last 20 years, we see that the market tends to bottom out around March 12th and then typically begins to rise. Of course, nothing is guaranteed. Every year can play out differently, but when pessimism and panic start spreading too much, it's often a sign that we might be approaching a turnaround. That's why I focus not just on the numbers, but also on overall market sentiment, because psychology plays a huge role in investing. Now that we understand the current market situation and investor sentiment, it's worth looking at what experienced investors and analysts are saying. Ron Barron, a well-known billionaire investor, believes that Tesla has massive potential in the robotaxi industry. According to him, Tesla could turn each of its cars into a source of passive income, which would fundamentally change the entire industry. Another interesting perspective comes from Tom Lee, a well-known market analyst who argues that current trade wars and tariffs are creating chaos in the market. But he also believes that the Fed might step in sooner than most investors expect. If they start cutting interest rates, it would provide a huge boost for stocks. Right now, the Fed is one of the biggest factors in play. If recession fears grow, we could see pressure to lower interest rates, which would give the market a much-needed push. So, while some investors are panicking, experienced ones are watching for opportunities. The real question is, what side do you want to be on? When I look at the current market situation, my strategy is clear. I'm using this volatility to build long-term positions while also trading short-term with options. My approach is divided into two parts. On one hand, I invest in high-quality companies that are trading below their fair value, companies that are currently on sale but have strong long-term potential. This includes companies like Meta, Google, and other tech giants that have gone through a correction but still have solid fundamentals. On the other hand, I use swing trades and option strategies to take advantage of short-term moves. When I see market chaos and oversold stocks, I often sell put options on companies that are undervalued at the moment but have strong long-term prospects. This approach allows me to profit in different market phases. When the market rises, my long-term investments grow, and when the market drops, I can use options to capitalize on volatility and buy strong stocks at better prices. From my experience, some of the best investment opportunities are created during times of uncertainty. Markets have always moved in cycles: fear, panic, sell-offs, and then growth. It's a natural part of investing. The key is knowing how to differentiate between short-term volatility and long-term trends. Many people make the mistake of panicking and selling everything when they see a drop. But if you look at history, the biggest gains have come to those who had the courage to buy when everyone else was scared. That's why I don't focus only on where the market will be tomorrow or next week. I look at the bigger picture and make decisions accordingly. If you found value in this video, be sure to give it a like and leave a comment with your thoughts. Do you think the market will drop further, or have we already found the bottom? Let me know, and I'll see you in the next video.